Health insurance is one of the biggest, most complex expenses that early retirees will face. If you leave the workforce before the age of 65 and you're not eligible for Medicare, this is something you're going to have to deal with. Did you know that nearly 60% of Americans cite health insurance and healthcare costs as the reason for not retiring early? So here's the big question about health insurance and early retirement. Can you afford it? Let's find out. In today's video, we're going to tackle that exact question. We're going to look at the affordability of health insurance options, we're going to look at eligibility, and we're going to talk about available plans and things to consider. I'm going to walk through some of the research I did when I was looking at health insurance as an obstacle for early retirement, and I'm going to share what I found. So before we begin today, I want to say something really important about this. I can't possibly give you a specific recommendation about health insurance. There are so many factors involved in this discussion. Your age, what type of employment you had, whether you're married, whether you have other dependents to support, existing medical conditions, the types of insurance you need, and even what state you live in. But the good news is I did research that I think will help. And it's not to make a decision for you, but to give you information and a head start that I didn't have. So when I looked into this, I found basically 7 options that I thought about and looked at. And I'm going to go through each one. I'm going to have to do this, again, at a fairly high level. The first option I looked at is called COBRA. Nearly half of all Americans get their insurance through an employer. It stands for the Consolidated Omnibus Budget Reconciliation Act. It's a funny way of saying you get to continue your benefits when you leave a job. It's a law that was passed many years ago. And effectively what COBRA is if you have a benefit plan that you like through your employer and you leave that job voluntarily or otherwise, they have to, by law, offer you the opportunity to continue with the same benefits. Here's what's cool about COBRA. You get to continue a benefit plan you like. The other thing that's neat about COBRA is it may be a lower cost option for you. You don't pay what you were paying while you were employed, because guess what? The supplements go away. Some of the other things go away. There may be some administration fees you have to pay. So your costs will go up, but maybe not as much as some other alternatives. By law, COBRA only has to be carried for 18 months. In my case, if I retire at 60 or 61 and I've used the COBRA option, well, it's only going to get me to 62 and a half if I, 18 months, which isn't a bad thing. If you like your plan and you want to stick with it, this is an option. One of the biggest benefits of COBRA is familiarity. If you're in a particular physician network or you like the coverage you have, COBRA is not a bad way to go. You get to keep the same health plan and you don't need to start over with something new, like finding a new doctor and all of that. It can be a lifeline for people who, again, if you have an existing situation in terms of a pre-existing condition or a family member who needs specific types of care and you have that, COBRA is a good 18 months where you get to figure things out and keep what you had. I'd say that's probably the biggest benefit to COBRA, and it's why a lot of people look at it. COBRA's there as kind of that bridging period for 18 months. On the negative side, you're paying the full premium. So you're not getting the supplement, you're not getting any subsidies. You pay what you pay. It's going to have a cost. It's got a limited time frame, as I said, only 18 months, so it's not forever. And it's not available if you didn't have insurance through your employer before. So COBRA costs, and this is just based on some averages, can run anywhere from $750 a month to $1,200 a month on the high end, and potentially more. You're going to have all the same deductibles you had and the same plan choices you had. So it's a continuation. COBRA is pretty straightforward. So if you're employed and you're leaving to retire, speak to your HR department. They can talk you through what your options are, what the plan would look like, and what the costs would be. If you're finding some challenges with the availability of COBRA, I'm going to put a link in the description, but you can go to the Department of Labor website and they have information about the COBRA program and how it works and what should be available. It won't speak to your specific benefit, but it can kind of help you understand the conversation you're going to have with your HR department. Right now, 16 million Americans are actually insured through the ACA marketplace. where a number of insurance companies that have decided to participate are offering programs to people who apply. The plans are pretty much open to everyone, but there can be a lot of variance in terms of what's offered, the costs, coverage. There are subsidies that help qualified individuals lower the cost, but that's where this can get complicated because you're going to have to fill out an application, you're going to have to do your research. Depending on your current income situation, the premiums are pretty good and there's some big ranges of cost, but it's largely based on your means. There's actually a wide variety of plans. There's quite a bit to choose from, and it includes most of the essential, pretty much all of the essential care needs, including preventive care. Some of the cons: if you're not eligible for the subsidies, the premiums are what they are. It's a funny thing about insurance. I feel like I just want to throw this in. It's like the one product we buy that both the buyer and the seller hope the person never actually needs to use. The other con for the ACA is the process. There's an application and you're going to have to like put in your data and look through it. And the marketplace can seem complicated because you're going to have choices to make. Go in well informed in terms of what you need and what your other cost options are, but definitely worth checking out. For somebody making less than $50,000 taxable income, you might see costs as low as $300 or $400 a month. Without subsidies, you might be looking at $700 to $900. Depends on the plans. It depends on what's available in your state. If you want to know more, this one's pretty simple. Again, link in the description, healthcare.gov. All right, so next up is an option that I didn't know existed until I started doing the research, but they're called healthcare sharing ministries. About 1.5 million Americans are actually covered through these healthcare sharing ministries. They don't operate like an insurance, but they're an interesting option, and if you're eligible for one, you might want to look into it. Members are part of this organization, are basically contributing to share healthcare costs. Think of it as a bunch of people pooling their resources and helping each other through these ministries. They can cover a variety of expenses. Technically, these are not insurance plans. Think about that. Make sure you read all of their policies and guidelines and everything else associated with them if you find one that could work for you. These are faith-based, so this is going to be available to you if you're part of a particular faith group or you're in a community that offers this. So might be a little harder to find, but they're out there and you can do some research. I'll throw a couple in the end just to talk about how to go about that. So some of the pros: you're probably looking at a much lower cost. They are community oriented, so that can feel supportive and it's great to be part of something like that. And they'll cover the major medical expenses. Maybe not everything you need, but it's, again, if you're really looking for something that's a low cost, this could be a way to go. The cons: they're not regulated like traditional insurance, as I said. They can kind of set their own rules, and payments aren't necessarily guaranteed, and they may have some qualifications to join. Read all the fine print, look into it, but something to check out. Like I said, honestly, hadn't heard of these until I started looking. From a cost perspective, these might only be $200 to $500 a month. So I found, when I did some searches, organizations called MediShare, Liberty Health Share, or Samaritan Ministries. These were like the big three that popped up. I'm pretty sure there's others. All right, so next up is another government program. This one is pretty widely known. It's called Medicaid. I'm not at all eligible for Medicaid, so it barely came on my radar, but I was curious. It offers a wide range of services, including preventive care. And because it's a government program, you don't need to worry about premium hikes and late enrollment penalties. And right now, 90 million Americans are actually enrolled in Medicaid. It's often extremely low cost. I mean, when it comes to cost, it can be free depending on your situation. And it's a comprehensive coverage, including long-term care. So if you are making less than $18,000 a year, you might be eligible for Medicaid. But bear in mind that they will look at assets, so things like real estate, savings, cash, portfolios of investment, that factors in. Through Medicaid, it's important to note there's access to doctor's visits, prescriptions. They cover a pretty wide variety. Pros: can be low to no cost, comprehensive coverage, and highly stable. On the cons, there's limitations. So I talked earlier about your doctors and your provider network. That's not everyone accepts Medicaid, so you're going to find yourself looking for providers that are in network. There's some state-specific requirements in the paperwork, and it can be a little complicated and daunting. Again, links in the description. Medicaid.gov pretty much tell you what you need to know, and from there you can navigate to your state-specific plan. So next up, spouse. So if we're talking to couples here, it's just a fact. Not every couple retires at exactly the same time. So if you're retiring earlier than your spouse, maybe you should take a look at their plan. So even if they were insured under your plan, you could look at their employer. And this is what's called a life event. So if you retire and leave a job, even outside the annual open enrollment periods, spouses can add you to their insurance, or they can start insurance that they didn't have. So it's definitely worth looking at. It may not be the lowest cost option, but it's probably lower than individual private insurance or some of the other things that we're looking at. You want to look at the eligibility and requirements for being on that insurance, and you want to make it part of the cost comparison. You may need to check some of the policies around qualified life events, but typically spouse retiring or spouse leaving a job is one of the eligible life events. This comes with some pretty clear advantages from a cost perspective. It's typically below most of the other plans, except for like Medicaid and the health-based ministries. But when it comes to ACA or individual insurance or COBRA, this'll typically come at a lower cost. Why? Because it's supplemented the way your plan was. So definitely something to factor in. Here's some of the pros, right? So the premiums will be lower than individual insurance. It's going to offer you all of the employer plans that are available from your spouse. And it's probably going to be pretty easy to enroll. So the cons, well, number one, it depends on what's available through your spouse. So in some cases, this is obviously not an option if your spouse isn't working, or if they're working for a company that doesn't offer insurance. This may not be available to everyone, but check into it, make sure that's the case. It's tied to your spouse's employment. So if anything changes with them, so if you retire and you're counting on your spouse's insurance for some period of time, you're subject to all the changes as well. Like if they're laid off, if they decide to retire, well, guess what? Now you're in the same boat. If something changes and they can't work, that's factored in here as well. And you want to look too, because sometimes there's a surcharge. If you're eligible for other plans and you opt not to use those plans, but to go on a spousal plan, they could ask what you're eligible for. And it's not a big deal. You just have to disclose it. But again, when you're putting these all side by side, this is about comparisons. If you want to learn more about your spouse's plan, there's no website that I can point you to, but I will say, if you're a couple, one retired, one not, and the spouse is working, talk to your spouse's HR department. Have the conversation. It's going to be pretty straightforward. You're either eligible or not, and you can look at the costs. And as is the message across all of these plans, stack that up next to each other and think about what your best options are. All right, so here's another one that's not available to everyone. Some people find part-time work. It's not as common, but there are companies that do offer insurance to part-time workers. This tends to be a thing with some of the big chains. I've heard Starbucks, Costco, Home Depot, depending on the situation, and they'll have minimum numbers of hours, but when I looked into it, it looks like many of those actually do offer insurance to part-time workers. Something to think about. Keep in mind, if you're thinking about working part-time and you're doing so for health benefits, the other thing is, I mentioned this in some of my other videos, if you retire and you're starting to collect Social Security, and like say you're 62 years old and you're going to claim early, well, there are limits on how much you can earn. So while this may cover your healthcare costs, it could affect your Social Security benefit claim. So be careful, do the research, look at the options, look at the cost, look at how many hours you'd have to work and how much you'd get paid. Put that all in the calculations. So another one, and again, I'm talking all ends of the spectrum here. We've talked about some really low cost options. We've talked about continuation. There is private insurance. I had private insurance at one point in my career. I actually, a few decades ago, I was operating as an independent contractor and sort of set up as a sole proprietor of my business, and the only insurance option I had, because my wife wasn't working and I had kids, was private insurance. It's not that hard to find. So again, there's plenty of brokers out there who do this. If you just search for Google private insurance, you'll find them. The thing is this: it can be expensive, really expensive. Why? It's that risk pool and subsidy conversation, right? So if you're going fully private, what's going to happen is you're just going to get charged as an individual based on what the actuarial data says about the insurance risk for you. So right now, 14 million Americans are actually insured through personal private insurance. When it comes to retirement, private insurance is ideal for people with the means who are really looking for those totally customized, have it your way plans. Effectively, you can choose, and there tends to be tiers to these plans. Like I said, I had looked at this. You're going to see them broken out as sort of like bronze, silver, gold, platinum. You can customize. So you could elect to have a pretty high deductible, co-pays, maybe some of the eligibility for certain claims might have restrictions. You have to look at it. Those will be lower cost, but out of pocket, if something happens, could be higher. And then it kind of tiers up from there. And so the way I would look at it is, if you think about the plan in terms of how much it's going to cost you from the low end to the high end, the other part of this conversation is how much coverage and out of pocket you're going to have, right? So each progressive tier, as you go up to silver, gold, and ultimately platinum, is going to offer you more and more coverage, more and more provider, doctor options, more things included, lower copays, maybe no copays, maybe all the way down to like very, very low, if any, deductibles. But that comes at a monthly premium cost. So platinum, as implied, if you can afford it, you probably get better insurance than you had through your employer, but you're going to pay a lot for it. So that's really the pros and cons. Cost, it's hard to say. There's so many of these plans, but figure more expensive than any of the other options we talked about. How do you find out about this? Well, you really want to find an insurance broker in your area. So do a search, look for private insurance brokers, and you'll find them. You can start the application process usually online, and at some point you're going to be talking to an agent, and you're going to most likely be going through a physical to make sure that you don't have anything that would make you a big risk for a single individual pool. If you're insuring a family, that could include other things. Because again, this can be challenging if there's pre-existing conditions or other things. The costs are just going to go up. But if you're in good health and you don't have some of those challenges, they get more expensive with age, but you might find that it's worth at least assessing the rates. I'm a believer in shopping around, and that's what a lot of this video is about. Lay these out side by side, go through some of the processes. You could apply for something and not buy it. If you want to look at what private insurance would cost, go right ahead, and then also go on the ACA marketplace. Also look at your spouse plan, like put them side by side. Be a smart shopper. That's the best advice I can give on a lot of this. So this video, actually, I decided to make it because in my earlier video about retiring before the age of 65, one of the questions that kept popping up in the comments is, what are you doing about health insurance? So here we are, and I decided to make the video. So if you've got a question like that, go ahead and drop it in the comments. I'm happy to be responding to the audience discussions. And I'm kind of interested in making more videos that are helping folks as they're trying to figure this out. So thanks again for watching. Some more videos coming up. I'm going to be talking in an upcoming video pretty soon, probably the next one, about my retirement strategy, where I was at a few years ago and how I was able to close the gap and make this happen. I'm going to be talking about some of us are working part-time or doing things to supplement these retirement years. And I'm going to be talking about those, some of the income opportunities that are out there for whether it's gig jobs or part-time work, as we've discussed. And I'm going to be talking about one of my favorite topics pretty soon, which is health, because I see a lot of comments where people are talking about lifespan and how long you're going to live after you retire. I'm going to talk about in an upcoming video how you're going to stay healthy in retirement, because that's when you're going to get the most enjoyment out of this. With that, thanks again. I hope this was helpful. See you around soon. Thanks for joining the Probable You. I'm John. Take care. Have a great day. We'll see you in the next video.